Hello and welcome to this session in which we will discuss inbound investment. What is inbound investment? Inbound investment, it's when an individual or an entity, a person or an entity could be a corporation, could be a partnership, could be some sort of a foreign trust. Those are from outside the US, invest in the US. So you have people from outside the US investing in the US of A. They could be individuals, they could be corporation, they could be trust, they could be anything. The US imposes taxes on these foreign investors for the income they generate within the US border. Now bear in mind, a foreign person, as I just mentioned, can be a person who are non-resident alien, meaning they don't meet the residency or the citizenship criteria to be considered a US person. It could be a corporation that are established and operate outside the US, but they have business in the US. It could be a partnership formed under a foreign law, a law of a country other than the US. It could be a trust and estate governed by a foreign law. So all these or any other individual or entity that does not qualify as a US person under tax law. So when we say a foreign person, it doesn't have to be an individual, one person. Any of those is a foreign person. So what we'll need to do, we will need to discuss when they have income in the US, how are they taxed? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
The first thing we need to know is there are two types of income. The US classified their income under two types. If a foreign person earn income in the US, it could be a business income, which is called ECI, effectively connected income, or it could be considered non-business income. The way it's treated, the way we treat them in the US for tax purposes is different, and this is what we will discuss. How is business income treated versus non-business income? We'll start there. What is business income? Well, when a foreign individual or an entity, they conduct business in the US, they have a place of business, they become liable for paying US taxes. That's directly related to their business that's operating in the US. Now, as I mentioned, this income is called effectively connected income, and it's subject to US taxation. How do we compute the taxes for those businesses? What we're going to do is we're going to take their income minus allowable deduction. So just like any other business, they have allowable deduction. And remember, we talked about how to compute the allowable deduction in the prior session or in a prior session. So it's income minus expenses. Then we'll go ahead and apply the rate that are used for US taxpayer. Now, these companies, they file a form called, since they're corporation, 1120F. F stands for foreign. Just basically in the US, we file for corporation form 1120. For foreigners, 1120F, very similar to it. This form is used to report what? Income and also any expenses. This is where you put your deduction. However, if a foreign investor chooses to establish a US subsidiary, a separate US legal entity to handle business operation, then this becomes a regular 1120, not 1120F, because now they're operating as a US subsidiary. In this case, the subsidiary is responsible for its income and paying taxes under the 1120, just a regular 1120. And this distinction makes sure that the subsidiary's earnings are taxed under US law, similar to any other domestic corporation, versus there are certain deductions under, foreign income allowable or not allowable. Under 1120, you become basically a US corporation. Let's take a look at an example just to kind of illustrate the concept of the net income. Let's assume a German company operates a US branch. The branch engages in manufacturing and sales of automotive parts to US customers. The gross revenue from the sales amounted to $200,000, and the expenses incurred in the manufacturing process, including the cost of the material, labor, and overhead, $120,000. How do they pay taxes? They pay taxes on the $80,000 remaining. They pay $80,000. So this amount will be subject to the U.S. taxation to business income effectively connected with the U.S. trade or business. So this is a business income. How about if you have non-business income? What is a non-business income? Well, think of what's a non-business income. You're not doing business. So how else can you get income? Well, you could be investing in stocks and bonds. So here we're looking at passive income. Somehow you are receiving income, but you are not doing the work. Why? Because your money is doing the work. So it's called passive income. Passive income, dividend, interest from U.S. sources. Now, unlike the business income, which is taxed on a net basis, it means you take your income minus deductions and expenses, non-business income will gonna get you on the gross basis. This means the full amount of the income is taxed without subtracting any cost or expense incurred to generate this. And what's the standard withholding rate for non-business income in the US? It's 30%. That's a lot. So simply put, let's assume you have a bank account in the US, you're a foreigner and you have a bank account in the US, and you want to, and you generated, for the sake of illustration, $100,000, let's assume stocks, and you generated $100,000 in dividend. When you want to take this dividend out, the US will take $30,000 out of it, and you can take $70,000 out. They will withhold $30,000. And believe it or not, and one of the jobs I used to do after college was working with a financial company. And in that financial company, we handled account for foreign persons, foreign individuals specifically. And they have stocks in Intel, they have stocks in Tyco, they have stocks in many U.S. companies because they did work, for example, for Intel Corporation, and Intel gave them stocks as form of compensation. Those stocks were in U.S. accounts. So when they sell those stocks and they wanted their money out, they were not aware that there's a 30% withholding. They were very upset about this. Now, bear in mind, that's the standard. This rate can be lowered if there's an income tax treaty between the U.S. and that foreign country's person. And these treaties, they, for what purpose, are agreements that aim to avoid double taxation and reduce tax barrier to international investment. So believe it or not, for some countries, if you fill out a form, and we do have this form on file for that individual, then you don't have to worry about the 30%. I still remember after we make a sale of stocks, we will not transfer the money until that individual send us a form. They sign a form, I believe it was, I don't remember the name of the form, but once they have this form, once we have it on file and if they're from that country, then we don't have to withhold 30%, or we can withhold less. Otherwise, 30% is withheld. Now, why is it withheld? Because the US want their share of the tax. And once you take your money out, the IRS, the US government, don't have jurisdiction over your bank account overseas. Therefore, they need to take their taxes now. Now, there are two systems of withholding taxes. So how do they, under what system they withhold the taxes? So the taxation of foreign person, non-business income falls under two distinct systems of withholding taxes. Again, these systems are there to ensure that the US government get their share of the tax. Because once you take the money out, that's it. The US cannot have a jurisdiction. They cannot force your bank overseas. If you are, obviously, if you're a non-US, we're talking about non-US person, to make you pay the taxes. So once that money leaves the US, they have no jurisdiction. That's why we want the money now. So there are two frameworks for applying withholding on non-business taxes earned by foreign individual or entities. The first one is we have something called Fixed Determinable Annual Periodic Income System, which is called FDAP. And the other system is called the Foreign Account Tax Compliance Act, known as FATCA. So I'm going to be referring this as to FATCA. This one is, I'm going to refer to this as FDAP. Starting with the FDAP, this system applies to investment income. So if you have dividend, interest, royalties, and certain type of compensation, alimony, any type of income other than what? Other than, we're going to see later, income in a foreign bank, FDAP applies here. The income is subject to tax, and the total default withholding rate is 30%. Again, the rationale behind withholding is to do what? Facilitate the collection of taxes from the foreign people who might otherwise be beyond the reach of the IRS. So the responsibility of withholding, remember, lies with the financial institution. So for example, I used to work for Merrill Lynch. Merrill Lynch is responsible for withholding this money on behalf of the US government. So the responsibility of withholding the correct amount is with the US payer of the income. which is the financial institution. So that's FDAP. How about FATCA? What does FATCA applies to? FATCA, the F in FATCA stands for foreign, was established to prevent tax evasion involving offshore financial account and investment by U.S. taxpayer. Now, FATCA requires foreign financial institution, known as FFIs, and certain non-financial foreign entities to report information about financial account held by U.S. taxpayer or foreign entities in which the U.S. taxpayer hold a substantial ownership interest. What does that mean? Think about having an account in Switzerland, or having an account in the Cayman Island, or having an account in a tax haven country in Hong Kong. Well, what's going to happen is this. FATCA says, well, if this is a U.S. taxpayer and they have their account overseas, well, you're responsible for informing us. If it's a foreign entity in which U.S. taxpayer hold a substantial ownership interest, you have to let us know. Now, failure to comply with FATCA, what does it failure to comply? It means you are not reporting to us those U.S. taxpayers. Then you have to withhold 30% in taxes. Now, what happens if the foreign bank says, I am not going to comply with FATCA? What can the U.S. do? The U.S. can remove them from the banking system. What does that mean? It's a kiss of death for the bank. So the financial institution will report those U.S. taxpayers. Otherwise, they will be we will boycott them. And once a bank is not part of the U.S. banking system, which is the largest international banking system, then the banking system is useless. No one's going to do business with them. So FATCA withholding is not aimed at foreign individual. Remember, FATCA applies to foreign entities, the foreign banks that hold U.S. accounts, but at foreign financial institution and entities that handle their investment. Again, think of a Swiss bank handling a U.S. account. They want to be in compliance with FATCA. They want to report all their U.S. accounts to FATCA, or a bank in the Cayman Island or the Bahamas. Now, FATCA does not apply to non-resident aliens. So if you are not a U.S. resident alien, you have nothing to do with the U.S., it doesn't apply to you. Foreign government, international organization, and certain type of retirement funds. Because FATCA is do what? The purpose of it is to make sure the U.S. taxpayers are not hiding their money in foreign banks, earning interest, and we in the U.S. are not aware of it. So just want to make sure you're aware of this. Now, generally speaking, foreign individuals are taxed by the U.S. only on the income they earned from sources within the U.S. Otherwise, if it's a foreign individual earned income in France, the U.S. has nothing to do with it. However, under certain conditions, under certain circumstances, a foreign individual, guess what? They could find themselves under U.S. tax obligation. Well, how? Because they might be deemed a U.S. resident for tax purposes. And under those circumstances, this individual now is required to pay taxes on all their income from all sources around the world, because now you are considered what? You are treated like a U.S. citizen for tax purposes. So how do we determine this? So the determination of a foreign person residency status for tax purposes involve specific criteria. What could make you deemed a U.S. resident? Well, you could have a substantial presence test, a green card test, or other qualifying factor under U.S. law. Starting with the easiest one, if you're a green card holder. If somehow you have to have a green card from your parents, from your grandparents, somehow you got a green card, and you visit the U.S. once a year or something like that, it doesn't matter. Under this test, a foreign individual is classified a U.S. resident for tax purposes if they have been granted lawful permanent residency in the country, known as a green card. And I know some people, I don't know them personally, but I know of some people that what they did, they dropped their green card because of this requirement. Because once they have a green card, for tax purposes, they are taxed in the U.S. under their worldwide income. And this status conferred to you by U.S. immigration law that allows the individual to live and work in the U.S. Now, obviously, if you have a green card, that's a great thing. Everyone, maybe you're listening to me overseas, in another country, if you can get a U.S. green card, yes, get the green card and pay the taxes. But some people, they may have too much money, they are connected to their country, that they have so many business activities, they just have the green card by default, like their grandparents or their parents gave it to them, and they don't really need it. and now they have it, and now it put them under this obligation. So what they did, they dropped their green card, said, I'm sorry, just we're gonna drop it because it's given us a lot of tax implication. So once an individual passed the green card test by obtaining the status, they're subject to US taxation on their global income, just like a US citizen and residents. So this is the green card test. Then we have what's called a substantial presence test. So you could be deemed a US taxpayer under this test. The substantial presence test is a method used by the US to determine the tax residency status of the foreign individual. So how does this test work? Well, a foreign individual could be deemed a US resident for tax purposes if they meet two conditions. Well, what are those two conditions? They are physically present in the US for at least 31 days during the current calendar year, and plus they are present in the US for a total of 183 days or more over the 3-year period, which include the current year and the 2 preceding year. And this computation uses a weighted average to compute the days. For example, in the current year, all the days of the individual was present in the current year is multiplied by 1. So it's 1 day for 1 day. It's counted that way. Then we'd look at the prior year, prior to the current year, and we'd look at the number of days that you spent in the US in the prior year, and it's 1/3 multiplied by 1/3. Then we would look at days present in the US 2 years prior to the current year, and we multiply those days by 1/6. When we add them all up, if they add up to more than 183 days or more, guess what? You have a substantial presence in the US, and you are subject to the US tax residency status. So the sum of the weighted days must meet or exceed 183 days to be considered a resident under the substantial presence test. Okay, in this approach allow what? The US to assert tax residency over individual who spend, if you're spending a substantial amount of time in the US over a rolling 3-year period, you are subject to the taxation of your worldwide income in the US. Let's take a look at an example just to see the numbers. Let's assume Carlos, a Brazilian citizen, visited the US for 100 days in each year 1, year 2, and year 3. 3 years. Well, determine whether Carlos is considered a US tax resident. Okay, so in year 3, after 3 years. Well, to ascertain this, we're going to take the first year, and Carlos spent 100 days. We're going to multiply this by 1. 100 days is equal to 100 days, year 3. Year 2, the prior year, Carlos spent 100 days, and we're going to multiply this by 1/3. That's going to be 33.33. Well, the year before, we're going to take 100 days multiplied by 1/6, 1 divided by 6, and that's 16.67 days. Now we're going to add them all up. And when we add them all up, they equal to 150 days. Is Carlos deemed to be a US resident for tax purposes? And the answer is no, because Carlos needs to do what? Meet or exceed 183 days. It's less than 183 days. Carlos failed the test. Let's take a look at the first year election, which the first year election could make you a US resident for tax purposes. Election means what? It's an option. The first year election is a provision that allows for an individual the option, the election, to be considered a US resident for tax purposes. For tax purposes. So you're not US resident, you are a US resident for the sake of paying taxes from an earlier date that they might otherwise qualify under the substantial test. To use this election, the individual must satisfy certain criteria. What are they? They must be physically present in the US for at least 31 consecutive days within the current year. So they have to be 31 days consecutively in the US. They must be present in the US for at least 75% of the total days, starting from the first day, the 31 consecutive day period, and continuing until the end of the year. Don't worry, I'm going to work numbers with 1 and 2. So you have to meet this, and you have to meet the substantial presence test, which is what we looked at on the prior slide. So to make this election, the individual must either file for an extension for filing their tax return for the first year in which they wish to be considered, because they might be a little bit late, or submit an amended tax return for that year. So the election provides a pathway for individual to choose to be taxed under the US resident. Now, why you want to choose this? I really don't know, but that option is available. When they might, in a year, they might not automatically be considered resident under the standard test, potentially allowing them for an earlier start of the residency tax status. You want to be considered a tax resident? Let's take a look at this example to illustrate the first year election. Sophia came to the US April 1st and stayed continuously for 60 days, leaving on May 30th. Then she returned to the US October 1st and she stayed till the end of the year, which was an additional 92 days. Well, let's see if Sophia can have the first year election. Well, did she meet the first 31 consecutive days? And the answer is yes. The first time she stayed 60 consecutive days starting from April 1st. So she met the first criteria, 31 days. Then, did she meet the 75% requirement? Well, starting from April 1st, the first 31 consecutive days until the end of the year, there are 275 days. Now, did she stay 75% of that? Well, let's see. Sophia was present in the US 60 days from April 1st till May 30th. Then on her second visit, she spent 92 days. So 60 plus 92 is 152 days. Well, to meet the 75% test, 75% of 275 is 206 days. Well, she only stayed in total 152. She would need it to spend in the US 206.25 and meet the substantial test. Therefore, she doesn't qualify for the first year election. I did not look at the third test, the substantial presence, because we already looked at the substantial presence, how to compute this. So she failed the first year election. Let's take a look at this multiple choice questions from farhatlectures.com. What is the primary purpose of Foreign Account Tax Compliance Act, known as FATCA? So FATCA, what does it apply to? Is it to reduce U.S. trade deficit, to increase U.S. export, to combat tax evasion by U.S. persons using foreign account, to enforce U.S. immigration laws? You need to know what FATCA is. FATCA applies to U.S. individuals who holds account in foreign institution, in foreign banks. They force the bank, they want to make sure the bank is reporting those U.S. taxpayer. So what's the answer? The answer is C, to combat tax evasion. Because what was happening is this: before FATCA, U.S. with substantial amount of money, they will open a bank account in Switzerland or in a country, it's a tax haven, and they will earn interest and dividend and income, and the U.S. will not be aware of this, and they will not pay taxes on that. FATCA forces these institutions to report their U.S. taxpayers to the U.S. government. And the answer is C. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to do what? Help you prepare for the CPA exam, help you prepare for your accounting courses. Invest in yourself. Good luck, study hard, and of course, stay safe.